Imagine getting that call or, maybe an email, and it just changes everything. A loved one's passed away and, well, you find out you've inherited something significant. Could be a life-changing amount of money, maybe a portfolio, property, maybe a mix of things you just never expected.
Yeah.
It's a windfall, no doubt about it. And it holds this incredible potential, right? Clearing debt, securing your future, maybe finally funding that dream you've had forever.
Absolutely. The possibilities seem endless at first.
But let's be honest, that potential comes tangled up with grief, right?
Yeah.
And this sudden, unexpected responsibility. And frankly, it's a financial situation that can feel, well, incredibly overwhelming, almost overnight.
It really is. It's such a complex mix of emotions and practical decisions hitting you all at once.
And that period, it's often marked by really high emotions. Sadness, sure, maybe relief too. Sometimes just anxiety about what happens next.
Exactly. And as all the sources we looked at show, making huge financial decisions when you're in that state of mind, that's often where people make the biggest mistakes, really costly ones.
And that is precisely why we're doing this deep dive today. We've gathered a pretty substantial stack of material. Everything from practical guides put up by big names, Synchrony Bank, American Century, Merrill Lynch, S&T Bank, plus detailed articles from law firms that specialize in estate planning, like Soward's Law Firm and Focus Partners Wealth.
Right, the professional perspective.
Exactly. But we also dug into some incredibly candid, real-world stuff, experiences, and sometimes pretty blunt advice shared in an online personal finance forum.
Oh, yeah. Those can be eye-opening.
Totally.
Yeah.
And also, crucial warnings about scams from places like Western Union. All of it focused on this one essential topic. How do you navigate and wisely manage an inheritance here in the U.S.?
So our mission for this deep dive is really to sift through all that info, pull out the absolute must-know insights, and give you, our listener, a clear, actionable roadmap.
Empower you.
Right. We want to empower you to approach this whole situation thoughtfully, sidestep those common pitfalls, and make smart financial moves that really honor the gift you've received, and hopefully build a more secure future. Doesn't matter if it's a huge amount or something smaller.
Okay, so you've gotten the news, the initial shock, the grief, maybe it started to settle just a tiny bit, and now you're looking at this new reality. Where do you even start? What are those first absolutely critical steps?
Okay, the single most important piece of advice, and this came through loud and clear from every single source we looked at, from the banks to the forums, is this. Don't rush.
Don't rush.
Seriously. Pump the brakes hard.
Okay, don't rush, but that flies directly in the face of that immediate feeling, doesn't it? That urge of, wow, freedom, or seeing something you've always wanted and thinking, finally, I can actually afford it.
It absolutely does. And that's exactly why it's the golden rule here. The sources are completely unanimous. The most devastating mistakes, the ones that cause people to burn through an inheritance really fast, that lottery winner effect where the money's just gone in a couple of years.
Yeah.
They also always stem from hasty, impulsive decisions. Decisions made when emotions are running super high and, frankly, objective financial thinking is pretty low.
So that means putting off buying that fancy new car, the boat, the, spontaneous trip around the world.
Exactly those things. And just as critically, resisting the urge to jump into those can't-miss investment opportunities that friends or acquaintances suddenly start pitching you because they heard you came into some money.
Ah, yes. The helpful tips start pouring in.
Oh, they do. Those shiny objects, whether they're things you can buy or investments that sound too good to be true. That's where people get into serious trouble. You absolutely need to create some space, time and mental space, before you commit to anything big.
Okay, so you're taking that essential pause. What's the very first, practical thing you need to actually do during that pause?
You need to take stock of everything. Get your arms around what you actually received. An inheritance is rarely just a single check, right?
Yeah.
It can be incredibly diverse. So you need to understand exactly what's in it.
Okay, so not just cash. It could be, investments, stocks, bonds, mutual funds, maybe?
Yep. Could be physical stuff, too. A house, maybe another property, a car, even valuable art, jewelry, collectibles. Precisely. And, importantly, it could include retirement accounts. Things like traditional or Roth IRAs, maybe 401ks from the person who passed. Life insurance proceeds, annuities, maybe even a share in a family business.
Wow, okay. That could be a lot to track down.
It can be. Your first task is just to inventory all of it. Gather statements for any accounts, get appraisals if needed for the physical assets, figure out the type and the estimated value of every single piece. This detailed inventory, it's the absolute foundation. Everything else gets built on this. You just can't manage what you don't fully understand.
Makes sense. And while you're digging into all those different pieces, what do you do with any actual cash you might have received already? Just leaving a big chunk of money sitting in a regular checking account feels wrong.
It's not ideal, no. The sources strongly advise against that for a couple of key reasons. You need to secure your cash immediately. And that means moving any cash portion into a safe, easily accessible place. And crucially, an interest-bearing account while you're in that assessment and planning phase.
Okay. Safe, accessible, interest-bearing. What does that look like practically?
Think federally insured accounts, high-yield savings accounts, HYSAs, or money market accounts, MMAs, are what you see recommended consistently in the sources.
HYSAs and MMAs. Okay.
Yeah. They usually offer significantly better interest rates than your typical checking account, which is important. And critically, your principal is protected by FDIC insurance.
Right. FDIC insurance, that's the safety net. How much does that cover? What if it's a really large cash inheritance?
That is a critical point. FDIC insurance currently covers up to $250,000 per depositor per insured bank for each account ownership category.
Okay, $250,000 per depositor per bank. So if you inherit, let's say, $800,000 in cash, you can't just dump it all into one HYSA at one bank, because $550,000 of that wouldn't be insured if something happened to the bank.
Exactly right. That's a huge risk you don't need to take. To make sure your entire cash inheritance is fully protected by FDIC insurance while you figure things out, you'd need to strategically spread that money across different banks.
Okay.
Could, for example, open accounts at 4 different FDIC-insured institutions, put $200,000 in each. That keeps you well within the limit at each place.
Gotcha. Spread it out.
Or, you could explore different account ownership categories at the same bank, like individual versus joint. But honestly, splitting it across different banks is often just simpler and clearer for beneficiaries.
That makes a lot of sense. So HYSA or MMA for that combo of liquidity and safety while you plan. Are there other good short-term spots for the cash?
Certificates of deposit, CDs, are also mentioned as an option.
CDs, okay.
They can sometimes offer slightly higher interest rates than HYSAs, especially if you go for longer terms, like, say, a 1-year or 2-year CD.
Yeah.
But the trade-off is flexibility. Your money is locked up for that CD's term.
Right, you can't easily pull it out if you need it.
Exactly. Withdrawing early usually means you pay a penalty, often giving up some or all of the interest you earned. So CDs are really best for cash that you're absolutely certain you won't need immediate access to for that specific period.
Got it. So park the cash safely, quickly, make sure it's earning some interest, and stay within those FDIC limits. And the ultimate goal of this whole initial phase, the pause, the assessment, the securing the cash.
It fundamentally buys you time, and it protects the principal amount. Time to process everything emotionally, time to think clearly about your options, and importantly, time to get expert help without feeling pressured to make instant investment decisions or, risk falling prey to those impulsive spending urges.
Right.
And stashing the cash in an interest-bearing account, even a modest rate, helps fight against inflation eroding your purchasing power, while the money is basically sitting there waiting for its long-term assignment. It's about preserving the value of the gift you received.
Okay, so the initial shock is managed, the assets are inventoried, the cash is secured safely. What is the next absolutely essential step that pretty much every single source recommended?
Once you've done those first things, pause, assess, secure, the very next universal recommendation is this: seek expert guidance.
Get help.
Yes, you absolutely do not, and frankly should not, try to navigate this incredibly complex financial, legal, and tax landscape all by yourself.
Yeah.
Especially if the inheritance is substantial or involves, lots of different types of assets.
Yeah, this came through really strongly across all the different sources we looked at, didn't it? From the banks to the law firms to the foreign parties.
Exactly.
So who are the key players? Who do you need on your team?
There are typically 3 core professionals you'll want to consult right away. First up, a financial advisor. They're the ones who can help you see the big picture. How does this inheritance fit into your overall financial life? They help you understand its potential impact, clarify your long-term goals, figure out your comfort level with investment risk, and ultimately help you build a comprehensive strategy for the money.
Now, this is where that online forum discussion we looked at got really specific and maybe a little opinionated about financial
It
advisors.
certainly did, and it's actually a really crucial distinction for you to understand as a listener. The strong consensus among the, let's say, financially savvy folks discussing this in that forum was to look for fee-only fiduciaries.
Okay, fee-only fiduciary. That sounds kind of technical. Can you break that down?
Absolutely. Let's take fiduciary first. A fiduciary is a professional who is legally and ethically bound to act solely in your best interest. Always.
So they have to put my interest ahead of their own.
Exactly. Think of it like a doctor. They're supposed to recommend what's best for your health, even if it means they personally make less money on a particular treatment. This is different from some other financial professionals who might only have to recommend products that are merely suitable for you, which isn't quite the same high standard. Suitable could still mean recommending something that pays them a higher commission, even if a lower cost option is actually better for you.
Okay, that's a key difference. And fee only.
Fee only means the advisor gets paid only by you, the client, directly through fees. They do not receive commissions, kickbacks, or any other compensation from selling specific investment products, insurance policies, mutual funds, whatever.
Ah, I see.
This structure is designed specifically to minimize those potential conflicts of interest. The fees might be an hourly rate for advice, a flat fee for creating a financial plan, or, very commonly, a percentage of the assets they manage for you. That last one is called assets under management, or AUM.
Right, AUM fees. And the Reddit discussion had some pretty strong feelings about that AUM model, specifically for inheritances.
They really did. While AUM is a super common way advisors get paid, the users in that forum raised some serious flags about the inherent conflict of interest it can create, particularly when you're talking about a large sum like an inheritance.
How so?
Well, think about it. If an advisor's pay is a percentage of the money they manage for you, they have a direct financial incentive to keep as much of your money under their management as possible, right?
Yeah, makes sense.
So they might be less inclined to recommend simpler, potentially lower-cost strategies, like maybe just investing in broad market index funds yourself, even if that might truly be in your best interest. They might favor more complex portfolios or actively managed funds that justify their ongoing fee.
And they gave that specific example, didn't they? Someone was quoted like 1.34% on a $700,000 inheritance.
Yes, exactly. A user shared that, quote, 1.34% on the first $750,000 managed. And the reaction from the forum community was immediate and strong. They pointed out that anything over 1% AUM is generally seen as pretty high by people who are really watching fees. And they really hammered home just how much that seemingly small percentage eats into your returns over the long haul because of compounding. One person actually ran the numbers and showed how a 1.34% annual fee on that $700,000 portfolio could end up costing you, well, a huge chunk, potentially a third or even more, of your total investment growth over, say, 20 or 30 years.
Wow, a third of your potential growth just gone to fees. That really puts it in perspective. It highlights why digging into how an advisor gets paid is so, so important.
It absolutely does. It's a stark reminder of the power of compounding both for your investments and for the fees you pay. So while many mainstream sources just say get a financial advisor, that real-world discussion pushes you to ask tougher questions. What kind of advisor? How exactly are they compensated? Are they legally a fiduciary? The strong preference in that community was definitely towards flat fee advisors for specific planning needs, or even managing the assets yourself using low-cost index funds or ETFs through major brokerage firms, especially if you're willing to learn. They saw high AUM fees as a major potential pitfall to avoid with a windfall. So the takeaway is, do your homework, interview several advisors, understand their fee structure completely before you sign anything.
That's incredibly valuable, practical advice. Okay, who else is essential on this professional team besides the advisor?
An equally critical member, maybe even more so initially, is a tax professional or accountant. Seriously, this is non-negotiable.
Because taxes on inherited stuff are messy.
Incredibly messy. The tax implications are super complex. They vary wildly depending on the type of asset you inherit, your state of residence, the state where the person lived, and how you eventually handle or distribute those assets. It's a minefield. An experienced tax pro will help you understand any potential tax liabilities you might face. They'll advise you on things like whether you need to make estimated tax payments, for example, if you get a big life insurance payout, and leave it with the insurer earning interest. That interest is taxable income to you.
Ah, good point.
And critically, they'll help you take advantage of tax-saving rules like the step-up in basis, which we absolutely need to talk more about later. They make sure you follow all the tax laws correctly and structure things to be as tax efficient as possible.
Okay, advisor, tax pro. Who's the third core professional?
An estate planning attorney. Now, you might think their job was done when the estate was settled, but their expertise is crucial for you as the beneficiary now.
How so?
Well, first, they ensure the proper legal transfer of all the assets into your name, making sure titles, deeds, accounts are all correctly updated. That's essential. But maybe even more importantly for you now, receiving a significant inheritance means it's absolutely vital to update your own estate plan.
Because my financial picture just changed dramatically. My own will, beneficiaries, all that stuff.
Exactly. Your net worth, the types of assets you own, it's all different now. An estate planning attorney can help you review your existing will, or create one if you don't have it. They'll help you set up or review powers of attorney for finances and healthcare directives.
Right.
And they can advise you on whether trusts might now be appropriate for your situation. Maybe to protect these inherited assets for your own kids, or for future tax planning, or, and this is a critical point highlighted in one source, to make sure receiving this inheritance doesn't accidentally disqualify you or a family member from crucial government benefits you might currently rely on.
Whoa, wait. You could lose benefits just by inheriting money? That sounds like a huge potential problem.
It is a significant risk, especially for things like SSI or certain Medicaid programs that have strict asset limits. An estate planning attorney is the expert who can help you figure out if that's a danger for you, and if necessary, help set up legal structures, like certain kinds of trusts, before you officially receive the assets to potentially avoid that disqualification.
Okay, that's another reason to get professional advice early. Any other specialists you might need depending on what you inherit?
Yeah, it really depends on the specifics. If you inherit valuable art, antiques, or jewelry, you'll likely need a certified appraiser to determine their fair market value, maybe for tax purposes or insurance.
Makes sense.
If you inherit real estate that you plan to sell, you'll need a good real estate agent. If it's an interest in a private business, you might need a business valuation expert to figure out what it's worth. The big picture here is that bringing these experts onto your team early isn't just an expense, it's really an investment. They can help you understand all the nuances, avoid incredibly costly mistakes, especially tax mistakes and legal ones, and help you integrate this new wealth into your existing financial life in a way that actually supports your long-term goals. Even if you consider yourself pretty financially savvy, inherited assets have their own unique, tricky rules.
Okay, so you've done the crucial first steps, paused, assessed, secured the cash, and you've started assembling your professional dream team. What should be your immediate financial priority once those initial bases are covered? Where do you focus the money first?
A lot of the sources used a really helpful analogy here, one I think resonates. It's the oxygen mask principle.
Like on an airplane.
Exactly. You know how they always say, secure your own mask first before assisting others? Same idea applies here financially. The desire to immediately help out family members, pay off their debts, or make big charitable donations might be really strong when you suddenly have money.
Yeah, that impulse to share the good fortune.
Absolutely.
Yeah.
But the absolute priority has to be securing your own financial foundation first.
Put on your own oxygen mask first. It makes intuitive sense, but I can see how it might feel a little counterintuitive, maybe even selfish, when you've just received a windfall.
It can feel that way, but it's essential for long-term stability for everyone involved. If you immediately give away or spend large chunks without shoring up your own position, you risk ending up needing financial help yourself down the road, which doesn't help anyone.
Okay, so what does putting on your own oxygen mask look like in financial terms? What's step one?
The forces are very clear and consistent on this. Pay down high-interest debt.
Go after the most expensive debt first, huh?
Absolutely. High-interest debt, especially things like credit card balances, is like an anchor dragging down your finances. Using a portion of the inheritance to wipe that out is essentially like getting an immediate guaranteed return on your money equal to whatever exorbitant interest rate you're paying.
That's a great way to think about it. A guaranteed return.
Exactly. It's one of the smartest, most impactful things you can do with a windfall to instantly improve your financial health and free up your future cash flow. Get rid of it.
What about other debts like car loans, student loans, maybe even the mortgage?
Yep. After you've tackled the really high interest stuff, you can definitely look at other consumer debts like car loans or student loans. The decision on whether to pay off lower interest debt, particularly a mortgage, gets a bit more nuanced.
How so?
Well, one source rightly pointed out, if you happen to have a mortgage with a really low fixed interest rate, say 3% or 4% from a few years ago, using funds that could potentially earn you, say, 7% or 8% invested in the market over the long term to pay off that cheap debt might not be the mathematically optimal decision.
Right. You could potentially make more by investing the difference.
Potentially, yes. But on the other hand, there's a huge psychological benefit for many people to being completely mortgage-free.
Right.
That peace of mind has real value, too. So that's a decision to weigh carefully, probably with your financial advisor, looking at the numbers versus your personal comfort level with debt. But that high-interest debt, no question, eliminate it.
Okay, step one for the money. Wipe out those crippling high-interest payments. What's the next piece of building that solid foundation?
Build or substantially boost your emergency fund. This came up again and again as a critical use of a windfall.
The rainy day fund.
Exactly. The general guideline you see in the sources is to have somewhere between 3 to 6 months worth of your essential living expenses saved up. Some might even argue for more, depending on your job stability and dependence. And this money needs to be kept in a readily accessible safe account, like that high-yield savings account we talked about earlier.
An inheritance seems like a perfect opportunity to finally build that safety net from scratch if you don't have one, or make it really robust if it's looking a little thin.
It's a golden opportunity, truly. Having a fully funded emergency fund provides just immense peace of mind. It means that if life throws you a curveball, you lose your job, the furnace dies, you have a sudden medical bill, you won't have to immediately panic, rack up new high-interest debt on credit cards, or even worse, be forced to sell your long-term investments at potentially the worst possible time, like during a market downturn. It's your financial shock absorber.
Okay, so high-interest debt is gone, emergency fund is solid. What's the next logical step in figuring out what to do with the rest and building out your financial life?
With those immediate protective layers in place, you can now really shift your focus towards the future. And that means review and define your financial goals. This is a really critical forward-looking step, and it should be informed by that asset inventory you did earlier and the advice you're getting from your professional team.
So this is where you figure out what this money is actually for, beyond just sitting in an account. What do you want it to do for you?
Precisely. It's time to think broadly. What's truly important to you? What does this inheritance now make possible that maybe wasn't before? Start thinking about your short-term goals. Perhaps that necessary home renovation you've been putting off, maybe replacing a major appliance that's on its last legs, or yes, maybe even a modest, well-planned vacation after what's likely been a difficult emotional period.
Okay.
And then really dig into your long-term aspirations. Is it securing a comfortable retirement, funding your kids' or grandkids' education, buying a first home or maybe a vacation property, starting a business, or perhaps supporting causes you deeply care about through philanthropy?
Thinking bigger picture.
Yeah, and one source had a great suggestion here, an exercise. Try to imagine your ideal life if money wasn't the primary constraint. Don't be purely practical at first, just dream a little. What did that life actually look like? Then kind of bring it back down to earth and start prioritizing those dreams based on the actual amount of the inheritance and your existing financial situation.
That sounds like a powerful exercise. It shifts the focus from just having the money to what that money can actually enable in terms of living a more meaningful life, your ideal life.
Exactly. It makes it about being intentional with the wealth rather than just reacting to having it. And crucially, as you define these goals, you also need to try and attach timelines to them. When do you think you'll need the funds for that down payment? How many years are left until you hope to retire?
Because the timeline impacts how you invest.
Massively. The time horizon for each goal is a huge factor in determining the appropriate investment strategy later on. Money needed in 2 years should be invested very differently than money needed in 20 years.
Okay, so define the goals, give them timelines, make sure they align with that bigger vision for your life. This all sounds great, constructive. But now we have to tackle the big, scary elephant in the room for many people. Taxes.
Ah, yes, taxes.
This is where things can get really complicated really fast, isn't it?
It's arguably the most complex piece of managing an inheritance, and definitely an area where having that good tax professional on your team is absolutely invaluable. But let's start with a fundamental point that actually often surprises people.
Okay.
In the United States, inheritance is generally not considered income taxable at receipt at the federal level.
Wait, really? So just getting the check or the assets transferred into your name doesn't automatically trigger a federal income tax bill on the amount you received?
That's the general rule, yes. The IRS doesn't view the inherited assets themselves as taxable income to you, the beneficiary, when you receive them.
Okay, that's a huge relief for many people, I bet.
It is, but, and there's always a but with taxes, right?
Of course.
That doesn't mean the entire process is completely tax-free.
Because some states have their own rules, maybe?
Precisely. While the federal government doesn't impose an inheritance tax, a handful of states do. The sources consistently list these states as Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania.
Okay, only 6 states currently.
As of when we reviewed the sources, yes. If you live in one of those states, or if you inherit from someone who lived in one of them, you might owe state inheritance tax. However, these state laws often have exemptions, especially for close relatives. Spouses are usually exempt, and often children, grandchildren, sometimes siblings are taxed at lower rates or are also exempt. It varies state by state, so you absolutely have to check the specific rules for the state involved.
Gotcha. And just to make sure we're clear, the state inheritance tax is different from the estate tax, right? I hear those terms used sometimes.
Yes, very important distinction. They are different taxes. The estate tax, which exists at both the federal level and in some states, is a tax levied on the decedent's entire estate before any assets are distributed to the heirs.
So the estate pays that tax first.
Right. The federal estate tax currently only impacts very, very large estates because the exemption amount is extremely high, over $13 million per person for 2024 and 2025, based on the sources. Though it's worth noting that high exemption is scheduled to drop significantly after 2025 unless Congress changes the law.
Okay, so most people don't worry about federal estate tax.
Correct. The inheritance tax, on the other hand, like those state ones we mentioned, is levied directly on you, the heir, based on the value of the assets you receive.
Okay, clear distinction. Estate tax is on the estate, inheritance tax is on the heir. So for most people inheriting, the big tax considerations usually come after they receive the assets, right? Like from income the assets generate or when they eventually sell them.
Exactly right. This is where understanding the specific tax rules for different types of inherited assets becomes absolutely crucial, and where that step up in basis really matters.
Okay, let's dive into those. What about inheriting regular investments, like stocks or mutual funds held in a standard taxable brokerage account?
Yes. For these types of taxable investment assets, the single most important tax concept to understand is the step up in basis. This is a major, major tax advantage for heirs in the U.S. tax code.
Step up in basis. I've definitely heard that term thrown around, but honestly, it sounds pretty complicated. How does it actually work?
Okay, let's break it down. It basically means that for tax purposes, the cost basis of the asset you inherit is stepped up or adjusted to its fair market value on the date the original owner passed away.
Okay.
A source gave a really clear example. Let's say your dad bought some stock shares maybe decades ago for $75 per share. On the day he passed away, those same shares were worth $575 each. Because you inherited them, your new cost basis for those shares isn't his original $75. It's $575, the value on the date of death. It's treated as if you had bought them yourself for $575 on that day.
Wow. Okay, so why is that such a big deal for taxes?
Because when you eventually sell that inherited stock, you only have to pay capital gains tax on any appreciation that happens above that new stepped-up basis of $575.
Huh.
So if you decide to sell those shares, say the day after you inherit them, you get $575 per share, your capital gain is $0, $575 sale price minus your $575 basis. You owe zero capital gains tax. Instead of inheriting them at your dad's original $75 basis, if that were the case, selling them at $575 would mean you'd have a $500 capital gain per share, $575, and you'd owe capital gains tax on that entire $500 profit.
Holy cow. Okay, so the step up effectively wipes out the capital gains tax liability on all the growth that happened before the original owner died. That's huge.
It is absolutely huge, and it gives you incredible flexibility as the inheritor. It means you can often sell inherited investments pretty much immediately without triggering a massive tax bill, assuming they haven't shot up in value significantly since the date of death, and then reinvest that money according to your own financial plan and risk tolerance. You aren't necessarily locked into holding on to Grandpa's favorite stock just because you want to avoid a huge tax hit.
That's incredibly useful.
And one source pointed out a pretty savvy tax strategy related to this. If you're charitably inclined, it's often more tax efficient to donate appreciated stock from your own existing taxable investment portfolio rather than donating the stock you just inherited.
Why is that?
Because when you donate appreciated stock that you've held for more than a year from your own account, you typically get two tax benefits. You can deduct the full fair market value of the donation, if you itemize, and you completely avoid paying the capital gains tax you would have owed on that stock's appreciation if you'd sold it instead. Meanwhile, you hold on to the inherited stock, preserving its high stepped-up basis for yourself, which might be more valuable to you down the line.
Huh. That's clever, maximizing the tax breaks. Does this step-up rule apply to other assets too, like inheriting a house?
Yes, it generally does. Inherited real estate also typically receives a step up in basis to its fair market value on the date of death. So if you inherit a house and decide to sell it later, you'll only owe capital gains tax on any appreciation that occurs after that date of death value.
That could save a ton of money in taxes if it's a property that's been in the family for ages and appreciated a lot.
It certainly can make a huge difference. But just remember, owning inherited real estate isn't free while you decide what to do. You've got ongoing costs, property taxes, homeowners insurance, maintenance, maybe even mortgage payments if there's still a loan on it. Those costs continue until you sell it or make other arrangements, so you need to factor those into your planning.
Good point. Okay, so step up in basis is a really big positive for inheriting taxable investments and real estate. But what about retirement accounts? Things like traditional IRAs or 401ks, those were funded with pre-tax money, weren't they?
Ah, yes.
Wow.
This is where the tax treatment flips completely, and it's absolutely critical to get this right because mistakes can be costly. Inherited traditional IRAs and 401ks contain money that has never been taxed.
Right, the contributions are usually tax deductible.
Exactly. Therefore, any withdrawals you take as the beneficiary from these accounts are taxed as ordinary income to you in the year you take the money out.
Yeah.
Not capital gains rates, but your regular income tax rate.
Okay, ordinary income. That could potentially bump you into a higher tax bracket.
It definitely could, especially if you take out a large amount in one year. And the rules for when you have to take the money out got a significant overhaul recently with the Secure Act.
Right, I remember hearing about that. It changed things for beneficiaries, didn't it?
It did, quite dramatically for many. For most non-spouse beneficiaries inheriting these accounts now, the old stretch IRA option, where you could stretch out the required withdrawals over your own entire life expectancy, was largely eliminated.
So what's the rule now?
The primary rule now is the 10-year rule. This generally means the entire inherited traditional IRA or 401k account must be fully withdrawn, meaning the account balance must be zero by the end of the calendar year that contains the 10th anniversary of the original owner's death.
Okay, the whole account has to be emptied within 10 years. Simple enough. Or are there catches? Like, do you have to take money out each year within those 10 years?
That's where it gets a bit tricky. And it's a point of confusion the sources try to clarify. The answer depends on whether the original owner had already reached the age where they had to start taking their own required minimum distributions, RMDs, before they passed away.
Okay. How does that change things?
So scenario one, if the original owner died before they had started taking their own RMDs, currently that means before age 73, then you, as the non-spouse beneficiary subject to the 10-year rule, generally have flexibility. You could take distributions however you want within that 10-year window. You could theoretically take nothing for 9 years and then take the entire balance in year 10. Or you could spread it out evenly, or take it all in year 1. The key is the account must be empty by the deadline.
Okay, so full flexibility within the 10 years if they don't before RMD age. What's scenario 2?
Scenario 2. If the original owner died on or after the date they were required to start taking their RMDs, then the rules are stricter for you as the non-spouse beneficiary. You still have to empty the entire account by the end of the 10th year. But during years 1 through 9 of that 10-year period, you also generally have to take annual RMDs yourself, usually based on your own life expectancy, or potentially the owner's remaining life expectancy if that was longer.
Wow. Okay, so if they were already taking RMDs, you have to keep taking annual withdrawals plus empty the whole thing by year 10. If they weren't taking RMDs yet, you just have the 10-year deadline but can choose when to take the money out during that time.
That's a general understanding based on current IRS interpretations, yes. It's complicated, and remember, regardless of when you take the money out of that traditional inherited account within the 10 years, Every dollar you withdraw is taxed as ordinary income to you.
And if you mess up, like forget to take an RMD if one is required, or don't empty the account by the deadline.
There are penalties, big ones. Failing to take a required distribution used to carry a steep 50% penalty on the amount you should have taken out. The Secure 2.0 Act, according to one source, did reduce that penalty. It's now generally 25% of the shortfall and can potentially be reduced further to 10% if you correct the mistake quickly. But even 25% or 10% is a significant penalty you really want to avoid.
Absolutely. This just screams, talk to a tax professional, doesn't it?
It absolutely does. You need a clear plan for managing those withdrawals from inherited traditional accounts to meet the deadlines, manage the tax impact, and avoid penalties.
Okay, what about inheriting a Roth IRA? Those were funded with after-tax money, right? Does that make a difference?
It makes a huge difference in terms of taxation. Inherited Roth IRAs generally follow a similar 10-year withdrawal rule for most non-spouse beneficiaries, with the same potential exceptions for certain eligible beneficiaries like disabled individuals or minor children who might have different timelines.
So the 10-year deadline still applies to Roths?
Generally, yes. The crucial advantage, though, is that because Roth contributions were made after tax and the earnings grew tax-free, qualified withdrawals you take from an inherited Roth IRA are typically completely tax-free.
Tax-free, that sounds much better.
It's a significant benefit. You still have the deadline to empty the account, but the money comes out without adding a penny to your taxable income for the year.
Inheriting a Roth is definitely a nice situation to be in.
Okay, that's great. What about life insurance proceeds? How are they taxed?
Life insurance proceeds that are paid out to you as a beneficiary due to the insured person's death are generally not considered taxable income at the federal level. That lump sum death benefit typically comes to you completely tax-free.
So if I'm the beneficiary on a $750,000 life insurance policy, I get that $750,000 and I don't report it as income or pay income tax on it.
In most standard situations, that's correct. The death benefit itself is tax-free income. However, there's a key nuance to be aware of.
Always a nuance. Right. If you don't take the death benefit as an immediate lump sum, maybe the insurance company holds on to it for you in an interest-bearing account or pays it out in installments over time. Any interest that is earned on that death benefit is considered taxable income to you in the year you earn it.
Okay. So the original payout is tax-free, but any growth or interest on that payout afterwards is taxable.
Exactly. And for a large life insurance payout, that interest could actually be quite significant. So that's something to factor into your cash management plan. And you might even need to think about making estimated tax payments on that interest income during the year.
Good to know. So with all these different tax treatments, step-up basis here, ordinary income there, tax-free somewhere else, it seems like receiving an inheritance, especially one with taxable components like a traditional IRA or assets that generate income, could easily push you into a higher marginal tax bracket, at least in the years you take distributions or receive income.
That's a very real possibility, yes. The inheritance itself might not be taxed when you receive it, but how you manage and withdraw from those assets later will have tax consequences. And yes, that additional income could absolutely push your other earnings into a higher tax bracket, increasing your overall tax bill for the year.
So understanding that potential impact on your overall tax picture is a crucial part of the planning process.
It is. And the sources do suggest some strategies you might discuss with your tax pros to potentially mitigate being pushed into a significantly higher bracket. For instance, in years where you anticipate taking large taxable distributions from an inherited IRA, you might consider maximizing contributions to your own tax-advantaged accounts like your 401k at work, a traditional IRA if you're eligible, or a health savings account, HSA. Those contributions can reduce your overall taxable income for the year.
Okay, using your own tax shelters more.
Exactly. Or using tax-advantaged education savings plans like 529s that aligns with your goals. Also, if you itemize your deductions, strategically timing significant charitable contributions in a year when you have high taxable income from an inheritance could help offset some of that income.
Interesting planning points. The sources also briefly touched on taxes for other kinds of windfalls, just to kind of put inheritance taxes in context, right?
Yes, they did highlight the contrast, which I think is helpful. For example, settlements from lawsuits might be taxable only if they include punitive damages or replace lost wages. Compensation for physical injury is typically not taxed. Work bonuses. Tax is ordinary income, often with a flat 22% federal withholding taken out up front, but your final tax rate could be higher.
And lottery winnings. Everyone dreams of that, but the tax reality is harsh.
Very harsh. Lottery winnings face immediate 24% federal withholding, and then their tax is ordinary income up to the very highest federal bracket, currently 37%. Plus, you'll likely owe state and local taxes on top of that. A huge chunk goes to taxes. Tax refunds, on the other hand, aren't taxed at all because it's just the government returning your own money that you overpaid. And if you take money out of your own retirement plan when you leave a job, you face 20% mandatory federal withholding, plus usually a 10% early withdrawal penalty if you're under 59 and a half SMUDA and don't roll it over properly.
So seeing those examples really underscores that inherited assets often have unique and in many ways more favorable tax rules compared to a lot of other ways you might suddenly receive money.
Absolutely. Which reinforces why understanding the specific rules for inherited assets, especially that step up in basis and the retirement account rules, is so incredibly key to managing them effectively.
Okay. Taxes are definitely complex, very asset dependent, and clearly require expert help. But let's assume you've started navigating that landscape, you've got your team, you've got a plan forming. What are the smart financial moves to make now to actually build your future with this new wealth?
Right. So once those initial protective steps are done, the pause, the assessment, the secure cash, the debt management, the emergency fund is solid, and you've started defining your goals, the focus really shifts to making the money work for you over the long term. And that primarily means investing wisely.
And this isn't just, picking a hot stock tip you heard from your neighbor.
Please, no.
Yeah.
Absolutely not. As the sources consistently emphasize, smart, effective investing starts with two fundamental principles: diversification and asset allocation.
Okay, diversification. That means spreading the money around, right? Don't put all your eggs in one basket.
That's exactly it. Diversification is about spreading your investments across many different types of assets, different industries, different company sizes, different geographic regions, U.S. versus international. The goal is to reduce your overall risk. If one area of the market takes a hit, hopefully other areas are doing okay, which helps smooth out your returns over time.
Makes sense. And asset allocation, what's that?
Asset allocation is about deciding on the right mix of different broad asset types within your portfolio. The sources talk about the main building blocks: stocks, which represent ownership in companies and offer the potential for higher long-term growth, but also come with higher volatility and risk. Bonds, which are essentially loans you make to governments or corporations, are generally considered lower risk than stocks and can provide income and stability to a portfolio. And cash equivalents, like those HYSAs or money market accounts we talked about for short-term parking, they provide stability and liquidity, but very little growth potential.
Stocks, bonds, cash, the basic ingredients.
Exactly. And the right asset allocation, how much you decide to put into stocks versus bonds versus cash, is not one size fits all. It depends entirely on your specific financial goals, the time horizon for each goal, when you'll need the money, and your personal tolerance for risk. Someone saving for retirement 30 years away can generally afford to take on more risk and might have a much higher allocation to stocks than someone who's planning to use the inheritance for a house down payment in just 3 years.
That sounds like something you absolutely need to work through with your financial advisor, connecting it back to those goals you defined earlier.
Precisely. It's a core part of building your investment strategy. And a really key piece of investing wisely, specifically with an inheritance, is to review your existing portfolio and the inherited portfolio together. Don't just blindly mash them into one big account.
Why not, if they're both investment accounts?
Because the inherited portfolio was almost certainly designed for someone else. The original owner had their own age, their own financial goals, their own comfort level with risk, all likely very different from yours.
Good point.
If you just combine everything without thinking, you could accidentally end up way too heavily invested in one particular stock or industry sector. Maybe the original owner worked for a company and had a lot of its stock. Or the combined portfolio might have an overall asset allocation, say 90% bonds. That is completely wrong for your long-term goals.
Yeah.
But remember, that step up in basis we talked about. For many inherited assets like stocks and mutual funds, that step up gives you the flexibility to sell those inherited investments without a huge tax consequence, and then reinvest the proceeds into a portfolio that is specifically designed and allocated for your financial life, your timeline, and your goals.
That's a great advantage. Now, speaking of investing, especially if you receive a large cash inheritance, there's often that question, Do you invest it all at once, or do you kind of ease it into the market over time?
Yeah, that's the classic lump sum versus dollar cost averaging, DCA debate. And the sources acknowledge both approaches have pros and cons.
Okay, what's the case for investing the whole lump sum right away?
The main argument for lump sum investing is that, historically speaking, the stock market tends to go up more often than it goes down over the long term. So by putting all your money to work in the market immediately, you give it the maximum amount of time to potentially benefit from that historical upward trend. Statistically, over long periods, lump sum investing has often resulted in higher returns compared to DCA.
But it probably feels riskier, right? What if you invest it all right before a big market crash?
That's the psychological downside, exactly.
Yeah.
Investing a large sum all at once can feel really nerve-wracking, especially if the market seems high or things feel uncertain. You have that fear of, what if I invest today and the market drops 20% tomorrow?
Yeah, that would sting. So what's the alternative, dollar cost averaging?
With dollar cost averaging, DCA, you break up the large sum and invest smaller, fixed amounts of money at regular intervals over a set period. For example, if you inherited $600,000, you might decide to invest $50,000 every month for 12 months.
How does that help?
It helps smooth out your purchase price. When the market is down, your fixed dollar amount buys more shares. When the market is up, it buys fewer shares. This averages out your cost per share over time and, crucially, reduces the risk of investing your entire nest egg right at a market peak. It can feel much less stressful emotionally, especially in volatile markets.
But you might miss out on some gains if the market just goes straight up while you're still phasing the money in. That's the potential trade-off, yes. If the market rises steadily during your DCA period, you might end up with slightly lower overall returns compared to if you had invested the lump sum right at the beginning. DCA essentially prioritizes reducing regret risk over potentially maximizing returns. It also helps remove the temptation to try and time the market, which, as the sources consistently note, is incredibly difficult, if not impossible, to do successfully over time.
So lump sum might be better on average historically, but DCA might help you sleep better at night.
That's a good way to put it. The best approach for you likely depends on your personal risk tolerance, the current market environment, and is definitely something to discuss with your advisor.
Got it. Now, the sources also briefly mention some other, maybe more complex or less common types of investments, things beyond just stocks and bonds. Yes, particularly for individuals with very large inheritances and maybe a higher tolerance for risk and complexity, some sources mentioned alternative investments. This category can include things like private equity, investing in companies not listed on public stock exchanges, hedge funds, which use complex strategies, or direct investments in real estate projects, beyond just owning your own home or maybe one rental property.
Those sound sophisticated and maybe risky.
Very much so, on both counts. The sources were generally quite cautious when mentioning these. Alternative investments typically come with a significantly higher degree of risk compared to traditional stocks and bonds. They're also often illiquid, meaning it can be very difficult or impossible to get your money out quickly if you need it. They usually require very high minimum investments and involve complex structures and fees.
So, not for everyone.
Definitely not. While one source noted that maybe younger investors with a very long time horizon might consider a small allocation to alternatives for diversification, they are absolutely not suitable for most people or most inheritances. They require extensive due diligence, a deep understanding of the substantial risks involved, and should only ever be considered with specialized expert advice.
Okay, so for the vast majority of listeners managing an inheritance, the smart move is probably to stick with a well-diversified portfolio of traditional assets like stocks and bonds, maybe access through low-cost mutual funds or ETFs, tailored to their specific goals and risk tolerance.
That is overwhelmingly the fundamental prudent approach emphasized across the board in the sources we reviewed. Keep it simple, keep costs low, stay diversified, and align it with your plan.
Makes sense. Now, beyond just investing in the market, using the inheritance for saving for specific goals is another key smart move, right?
Absolutely. Once the foundation is secure, earmarking funds for specific, important future goals is a great way to make the inheritance work for you.
Like maybe setting aside money specifically for a child's or grandchild's college education?
Yes, that's an excellent example. Using a portion of the inheritance to fund tax-advantaged 529 education savings plans is a very popular and effective strategy. The money grows tax-deferred, and withdrawals are completely tax-free at the federal level and often state level too, as long as they're used for qualified education expenses.
That's powerful. Or if buying a home is a major goal.
An inheritance can be a game changer for home ownership. It could provide a substantial down payment, making buying a home possible much sooner than expected, or maybe even allowing you to buy a home outright, avoiding a mortgage altogether.
Wow.
If you're already a homeowner, it might open the door to investing in rental properties or other real estate ventures. But again, those come with their own set of complexities, costs, and risks, and should be evaluated very carefully with professional advice.
Right. And just revisiting the basic savings accounts is important too.
Definitely. Just making sure your emergency fund stays put in that high-yield savings account where it's safe but earning decent interest. And maybe considering CDs again for specific known future expenses that are, say, a few years out, locking in a guaranteed rate for money you know you won't need before then.
Okay. And finally, wrapping up the smart moves section, how does insurance fit into the picture after inheriting wealth?
As your overall net worth increases, potentially significantly due to an inheritance, it becomes really crucial to review your insurance needs.
To protect the new assets.
Exactly. You might need to increase the coverage limits on your existing homeowners or renters insurance, especially if you inherited valuable physical assets like art or jewelry that need specific riders. Even more importantly, though, for liability protection, you should strongly consider adding an umbrella insurance policy.
Umbrella policy, what does that do?
An umbrella policy provides an extra layer of liability coverage, typically $1 million or more above the limits of your existing home and auto insurance policies. So if you were ever found liable in a major lawsuit, say from a serious car accident or someone getting injured on your property, and the judgment exceeded your regular policy limits, the umbrella policy would kick in to cover the difference, protecting your accumulated assets, including the inheritance, from being wiped out.
Ah, okay. Extra protection for your bigger net worth.
Precisely. It's usually relatively inexpensive for the amount of coverage you get, and it's considered essential once your assets reach a certain level. It's also a good time to just review your own life insurance needs. Do you have enough coverage now to protect your dependents, considering your changed financial situation?
Got it. So many interconnected pieces. Investing wisely, saving for goals, managing insurance, all part of building that secure future. But just as important as making all these smart moves is actively avoiding the major pitfalls, the traps that people fall into. What are the big ones we need to watch out for?
We kind of started with the antidote, which was don't rush. And the most common classic manifestation of rushing is overspending. This is mistake number one, highlighted everywhere.
Blowing the money?
Exactly. Using the inheritance impulsively on luxury goods that lose value quickly, like those expensive cars, boats, maybe lavish vacations that not only cost a lot up front, but also create significant ongoing expenses like insurance, maintenance, taxes, storage fees.
It's that shiny objects trap we talked about right at the beginning, but maybe on a larger, more damaging scale.
Precisely. The sources are full of cautionary tales, anecdotes of people who received significant windfalls, inheritances, lottery winnings, settlements, only to see the money completely vanish within just a few short years. Why? Because they didn't adjust their spending habits sustainably. They tried to live like millionaires temporarily, and then suddenly the money was gone. And they might even be left with new debts for maintaining those expensive purchases.
And it ties directly into another major pitfall you see mentioned, not budgeting.
Yes, absolutely linked. If you didn't really have a budget before the inheritance, creating one now becomes absolutely essential. If you did have a budget, it needs a serious update to reflect this new financial reality.
Because the old budget doesn't account for this new resource.
Right. Failing to actually plan how the money will be allocated, how much goes to savings, how much to investments, how much towards debt reduction, and yes, how much is available for controlled, planned spending makes it incredibly easy for the money to just disappear. Slip through your fingers without you even realizing where it all went until it's too late. A budget provides that crucial structure and control.
Okay, here's a really serious one we touched on earlier that sounds like it requires very specific legal planning. Losing government benefits.
This is a critical, but sadly often overlooked pitfall. If you, or perhaps a dependent family member you care for, are currently receiving government benefits that are needs-based, meaning they have strict limits on income, and assets receiving an inheritance directly into your name could immediately disqualify you from those essential programs.
What kind of programs are we talking about?
Things like Supplemental Security Income, SSI, which provides income for disabled individuals with very low income and assets, certain types of Medicaid programs that cover health care costs for low-income individuals, sometimes other state or local assistance programs based on financial need.
And getting kicked off those programs because you inherited some money could be absolutely devastating for someone relying on them for basic living expenses or critical medical care.
It could be catastrophic. The sources really stress that for individuals who are beneficiaries of these types of programs, proactive planning is essential, ideally before the inheritance is actually received.
Planning with who? What kind of planning?
This typically involves working closely with an estate planning attorney who specializes in this area. The most common solution is often establishing a specific type of trust, frequently called a special needs trust or supplemental needs trust. The inheritance is then directed into this trust rather than paid directly to the individual. The funds in the trust can then be used to supplement the beneficiary's needs, paying for things government benefits don't cover without actually counting as their personal assets for the purpose of determining eligibility for those benefits.
Wow. So the trust holds the money for them, but not as them, legally speaking.
That's a good way to think about it. But this kind of planning absolutely must be done correctly, following very specific legal rules, and often needs to be set up before the assets are officially received by the beneficiary. It really highlights, again, just how complex this can be and why getting that professional legal help early is non-negotiable in situations like these.
Absolutely critical. Okay, another danger zone. Sadly, where there's money, there are often scams. Falling victim to scams seems like a significant risk for inheritance beneficiaries.
It really is. People who have recently lost someone or are known to have received money can be seen as vulnerable targets.
The sources we looked at had some pretty specific warnings about inheritance scams. How do those typically work? What should people look out for?
The classic scenario usually starts with an unsolicited contact. An email out of the blue, maybe a letter, sometimes even a message on social media. It claims you've inherited a large sum of money from a distant relative you've either never heard of or maybe only vaguely knew.
Okay, sounds suspicious already.
Right. The message usually comes from someone pretending to be a lawyer, maybe a bank official, sometimes a foreign government representative. And here's the key part. They claim they need your help and almost always your money to cover some fee or tax or legal cost in order to release the supposed inheritance funds to you.
The upfront fee. That's the big red flag.
That is the #1 giant red flag. Any request for you to pay money up front, whether it's called an administrative fee, a processing fee, taxes, legal costs, whatever, to get access to an inheritance is almost certainly a scam. Real expenses and legal fees associated with settling a legitimate estate are typically paid directly from the estate's assets before distribution, not demanded out of pocket from the beneficiaries beforehand.
Okay, upfront fees equals huge red flag. What are some other warning signs the sources mention?
Several others to watch for. Poor grammar and spelling errors in the communication professional legal or financial correspondence is usually polished. Using generic public domain email addresses like at gmail.com or at yahoo.com instead of an email address from a legitimate law firm or bank's domain, example at lawfirmname.com. A lack of verifiable online information if you try to Google the supposed law firm, bank, or lawyer's name and find nothing or only sketchy details, that's bad. The deceased person being completely unknown or only vaguely known to you. And of course, asking for your sensitive personal identifying information early on, like your bank account numbers, credit card details, or social security number, supposedly for verification purposes.
Okay, lots of red flags to watch for. So if someone does get contacted by something that smells fishy, feels like one of these inheritance scams, what should they do? What's the action plan?
The advice from the sources is crystal clear. Do not engage. Do not reply to the email or letter. Do not click on any links or open any attachments in the message. Do not call any phone numbers they provide. And absolutely positively do not send any money or give out any personal information.
Just cut off all contact.
Yes. The best thing to do is simply delete the email or discard the letter. You should also report it. You can file a complaint with the Federal Trade Commission, FTC, online at ftc.gov, and you might also report it to your state's Attorney General's office. Reporting helps authorities track these scams and potentially warn others. But remember, any money you send to scammers is almost always gone for good. It's incredibly difficult to recover.
That's sobering. If the inheritance is legitimate, how would you typically be contacted?
If it's real, the executor of the estate or a legitimate estate attorney handling the settlement will contact you through official channels. This might be via certified mail requiring your signature, or perhaps a phone call followed by official documentation. They will be able to provide verifiable details about the deceased, the estate, and the process, and they will not ask you for upfront payment to receive your share.
Okay, crucial advice. Vigilance is key there. What about pitfalls related to the investments themselves? You mentioned earlier not just mashing portfolios together blindly.
Yes, that's a common mistake, born from maybe not getting advice or not taking the time to review properly, blindly mashing portfolios together. As we discussed, your existing investment portfolio and the one you inherit were likely built with different goals, timelines, and risk levels in mind. Simply combining them without a thorough review of the overall resulting asset allocation can easily leave you with unintended consequences. You might end up with way too much exposure to a single company's stock or concentrated too heavily in one industry, or holding assets that are just fundamentally inappropriate for your age and financial goals. This dramatically increases your risk without you even realizing it. It needs a careful, deliberate review, ideally with your advisor.
Makes sense. And back to taxes again, just ignoring them is obviously a pitfall too.
Oh, absolutely. Ignoring your tax obligations related to the inheritance can lead to serious problems down the road. Failing to plan for and pay taxes on distributions from inherited traditional IRAs, or capital gains taxes if you sell inherited assets that have appreciated after the date of death step up, or taxes on any interest or income generated by the inherited assets, all of that can result in hefty penalties and interest charges from the IRS and potentially state tax authorities. Those penalties can quickly eat away at the value of the inheritance itself. Proactive tax planning isn't optional. It's essential.
And finally, maybe the overarching pitfall, trying to do it all yourself or listening to the wrong people.
Exactly. A major pitfall is going it alone or taking unsolicited advice. We keep coming back to this, but your qualified professional team, that fee-only fiduciary advisor, potentially, experienced tax professional, the estate planning attorney, those are the people whose advice you should generally rely on.
Not your brother-in-law's hot stock tip.
Probably not. Be extremely wary of can't-miss investment tips or business propositions from friends, family members, who might mean well but usually lack the professional expertise. Or certainly strangers, especially if they suddenly appear after hearing you've received money. That Reddit discussion we mentioned was particularly emphatic about this, warning against taking investment advice from anyone who stands to gain financially from that advice, specifically calling out the potential conflicts of interest, with advisors paid high AUM fees and cautioning against overly complex, high-fee products when simpler, low-cost options might serve you better. Stick to vetted professionals who have a fiduciary duty to you and rely on evidence-based financial strategies.
Wow, okay. That's a pretty comprehensive list of potential traps to navigate. Overspending, lack of budgeting, accidentally losing crucial benefits, falling for scams, making poor investment merges, messing up on taxes, and taking bad advice from the wrong people. It really, really underscores the need for caution, patience, and careful planning.
It truly does. Managing an inheritance is definitely a complex undertaking, and it requires diligence every step of the way. But having gone through that whole process we've outlined, taking the time to pause and secure the funds, building that solid financial foundation, defining your goals clearly, understanding the tax rules, making smart, deliberate investment choices, and actively avoiding those pitfalls receiving an inheritance also presents this incredibly powerful opportunity. Not just for your own financial well-being, but also to start thinking about your own financial legacy.
That's a really profound shift in perspective, isn't it? The gift that you received prompts you to think intentionally about the gifts you might eventually leave behind someday.
Exactly. Several sources highlighted this. Receiving a significant inheritance often acts as a catalyst, prompting people to finally get serious about their own estate planning. Your financial picture is fundamentally changed, so your previous plan, or maybe your complete lack of a plan, is almost certainly no longer adequate or appropriate.
So updating your own estate plan becomes kind of the final, crucial step in responsibly managing the inheritance you received.
You definitely see it that way. Create or update your estate plan. This is vital. It involves reviewing or creating your will to clearly state how your assets should be distributed after you're gone. It means checking and updating the beneficiary designations on all your retirement accounts, IRAs, 401ks, and life insurance policies. Because remember, those designations usually override whatever your will says for those specific accounts.
Good point. Beneficiary forms matter.
Hugely. It also involves considering whether trusts might now be appropriate for your situation, perhaps to provide for minor children, or to manage assets for a dependent with special needs, or maybe for more advanced planning to improve tax efficiency for your own heirs down the line. And of course, ensuring you have up-to-date powers of attorney for financial matters and healthcare directives, like a living will, is also a critical part of a complete estate plan. And tied into this whole idea of planning your legacy is the importance of family communication, which some sources mentioned as well. Once you have a plan, having open, honest conversations with your potential heirs, maybe your adult children, for example, about your financial plans and your intentions for your estate, can prevent a world of misunderstanding, potential conflict, and stress for them during an already difficult time in the future.
So talking about it reduces future problems.
Absolutely. It really honors the spirit of the gift you received by providing clarity and reducing the burden on those you care about most. It turns what could be a stressful, confusing future event into a more planned, understood transition.
That's a really powerful way to think about closing the loop, being a good steward of the gift, and planning for the future.
It's about managing the wealth responsibly while you have it and ensuring it can continue to benefit those you intended for, maybe even for generations to come, according to your wishes.
All right, we have covered a ton of ground in this deep dive. It's a lot to take in. Let's try to quickly recap that essential roadmap for managing an inheritance. What are the core steps?
Okay, let's boil it down. First, that critical initial phase. Pause. Absolutely resist making any big impulsive decisions right away. Assess everything you've actually inherited. Make that detailed inventory of all assets. And secure any cash immediately in safe, interest-bearing, FDIC-insured accounts, making sure to split funds across different institutions if needed to stay within insurance limits.
Got it. Pause, assess, secure. Step 2.
Seek expert guidance. Don't go it alone. Build your essential team of financial advisor. Remember to research their fees and fiduciary status. An experienced tax professional and an estate planning attorney are usually the core players. Bring in other specialists like appraisers if your specific assets require it.
Okay. Team assembled. Third.
Prioritize your financial foundation. Remember the oxygen mask principle. Secure yourself first. Pay down that high-interest debt immediately. Build or fully fund your emergency fund. 3-6+ months of expenses. Then take the time to clearly define your financial goals, both short-term needs and long-term aspirations, and attach timelines to them. Fourth, navigate the complex tax landscape. Understand the basics. The inheritance itself is generally not federally taxed at receipt, but watch out for potential state inheritance taxes. Critically, learn the specific tax rules for the types of assets you received. Master the step-up in basis concept for taxable investments in real estate. Understand the ordinary income tax treatment and the 10-year withdrawal rule, with possible RMDs, for inherited traditional retirement accounts, and the tax-free nature of inherited Roths. Plan proactively with your tax pro for the tax impact of future withdrawals, sales, or income.
Okay, taxes covered. Fifth step.
Make smart financial moves for the long term. Once your foundation is secure, invest wisely to grow the inheritance. Focus on diversification and asset allocation that are aligned specifically with your goals and risk tolerance. Carefully review inherited portfolios. Don't just combine them blindly with your own. Make a conscious decision about investing a lump sum versus using dollar-cost averaging. Be extremely cautious about complex, high-risk alternative investments. Use the funds strategically for specific goals, like education savings, 529s, or a home down payment. And importantly, review and potentially upgrade your insurance coverage, especially liability umbrella insurance. Sixth, and just as important, actively avoid the common pitfalls. Don't fall into the trap of overspending or failing to create and stick to a budget. Be acutely aware that inheriting could impact eligibility for needs-based government benefits and plan accordingly, potentially using a trust before receiving funds. Be hypervigilant against inheritance scams, know the red flags, especially demands for upfront fees, and know how to respond. Don't engage, just report it. Don't blindly merge investment portfolios. Don't ignore your ongoing tax obligations on income or withdrawals. And crucially, don't try to go it alone or take unsolicited financial advice. Rely on your vetted professional team and be wary of high fees or conflicts of interest.
Avoid the traps. Got it. And the final step.
And finally, seventh, plan your own legacy. Use this entire experience as a catalyst to create or update your own comprehensive estate plan. Ensure your assets will be managed during your life if needed and distributed according to your wishes after you're gone. Review and update key documents like your will, powers of attorney, healthcare directives, and especially those beneficiary designations. Consider if trusts are right for your situation now, and think about communicating your plans clearly with your family to provide clarity and ease future burdens for them.
Managing an inheritance. It's clearly so much more than just receiving a check or some assets. It's really a multifaceted process, isn't it? It involves navigating intense emotions, undertaking careful, deliberate planning, understanding complex rules and regulations, and making a series of informed decisions over potentially a long period of time.
It really is a journey, not just a single transaction. But with the right approach, taking that crucial initial pause, assembling a strong team of expert advisors, prioritizing your own financial health and security first, getting a handle on the tax implications, making deliberate and informed investment choices, and actively steering clear of those common pitfalls, an inheritance truly can be an incredibly powerful tool. It can significantly enhance your financial security, help you achieve long-held dreams and goals, and ultimately allow you to build and leave a meaningful financial legacy of your own.
It truly is a gift, but one that comes with significant responsibility attached. So the final thought for you, our listener, is maybe this. If you find yourself in this situation, how will you approach this moment? How will you choose to honor the intent behind that gift? How will you use it not just for immediate wants, but as a foundation to build a more secure, more fulfilling financial future for yourself and perhaps for those you care about most? What kind of financial future do you ultimately want this inheritance to help you create?
Definitely something worth some deep reflection.
Thank you so much for joining us for this deep dive. We truly hope this roadmap provides some clarity and helps you navigate the complexities and the opportunities of managing an inheritance.
Until next time.